Renowned Tesla supporter Cathie Wood betrayed Tesla by buying GM stock following their meeting with GM CEO Mary Barra in the previous year. Cathie's treason is likely to pay her dearly if the most recent news regarding General Motors is any guide. This morning, further details have surfaced that underscore the automaker's significant challenges. These difficulties might be a precursor to more significant problems later this year and in the upcoming 10 years. The end of GM is drawing near, and Cathie's $13 million investment might be lost. When Cathie initially purchased GM shares a year ago, renowned financial analyst Jim Cramer made this prediction. According to Cramer, Cathie's endorsement of GM would be a death blow for the business. But press that like and subscribe button before we delve any farther. For now, most of GM's salaried employees in the United States are eligible for buyouts. This is only the beginning of what the automaker is hiding. In essence, General Motors, GM, wants to make $2 billion in cost reductions this year, and one method they plan to do this is by giving workers the option to resign. This has happened to other automakers as well, and GM only stated a week and a half ago that it will be cutting approximately 500 salaried positions globally. Nearly all of the company's paid employees are now receiving offer letters. It is unclear how many employees will accept the buyout and whether this will prevent the business from needing to start more widespread layoffs. Allow me to explain what I believe is happening in light of GM's Q4 earnings results. Every quarter, their sales in North America remained stagnant, but there was a rise in the accumulation of inventories in the same area. This indicates that although dealership stocks increased, they sold the same amount of cars. Essentially, even though GM acknowledged it as a sale in their earnings report, the net sale of automobiles sold to customers in Q4 was lower than in Q3. Their sole activity involved transporting stock from their manufacturers to the dealership network. Dealerships are overstocked, particularly with regard to GM brands like GMC, Buick, and Cadillac. In contrast, Chevy had a good 60-day supply of inventories back in November. Since then, the car industry has sadly been slowing down, and things don't appear good for GM. There is a serious issue here. Dealerships' excess inventory of automobiles forced GM to halt manufacture of their best-selling truck. In actuality, consumers are just purchasing fewer automobiles, despite the fact that this has been presented as greater production in the face of consistent demand. Given that GM's primary revenue-generating vehicles are trucks and SUVs, and that they are currently suspending manufacturing of those models, the position is precarious. The most costly cars on the market are pickup trucks, which are the lifeblood of legacy automakers like GM. Cathie's ARK Invest funds are not looking good in this situation. Cathie Wood's ARK Investment Management changed its position on traditional automakers, which she had previously criticized in 2022 when it purchased 158,187 shares of General Motors GM for its autonomous technology and robotics ARK fund. The transaction was revealed in a report that included the latest trades made by the company. According to Forbes, Wood, a well-known stock picker who specializes in early-stage technology companies, oversees over $60 billion in assets through her company ARK Investment Management. Wood recently acknowledged her appreciation for General Motors' advancements in electric vehicles and autonomous driving technology, notably its Cruise subsidiary based in San Francisco, despite her prior criticism of traditional automakers. After meeting with the business's CEO, Mary Barra, Wood stated in an interview with Yahoo Finance that the corporation was thinking about investing in GM while keeping an open mind. They also talked about the company's electric vehicle plans. Wood highlighted GM's emphasis on Cruise automation and Barra's attempts to turn the firm around as examples of how important it is to have an open mind and recognize success. Compared to her past criticism of GM and Ford's plans for electric vehicles and her forecast that they might go bankrupt, this is a significant change. Returning to GM and the present state of the economy, it is difficult to overlook the significant slowdowns and job losses that are anticipated for businesses such as GM. Slowdowns are unavoidable, but what's really important to know is when the next cycle will start and how it will impact auto manufacturers. I think there are two obvious candidates for the next cycle. attractive electric vehicles, and reasonably priced automobiles. Affordability is growing increasingly important as a result of the Fed tightening rates and consumers finding it difficult to make ends meet. It should see. In all of this, where does GM stand? Sadly, it appears that they are having problems. Although the Chevy Bolt is one of the more reasonably priced EVs available, it is not without its problems. Buyers are discouraged by the car's numerous recalls. It's obvious that GM needs to adapt and produce attractive, reasonably priced EVs if they want to stay relevant in this shifting market, especially with layoffs and production pauses imminent. Affordable vehicles from GM, such as the $45,000 Blazer EV and the about $30,000 Equinox EV, which go on sale in the autumn of 2023, could help them reach their objective. For their next vehicles, which include the Lyriq, Blazer, Equinox, and Silverado, and are anticipated to go on sale in 2024 and 2025, they must, nevertheless, increase production. In the competition to create an EV that is affordable for the general public, Tesla is far ahead of the pack. Elon Musk, the CEO of Tesla, has said that when the carmaker's next affordable electric vehicle goes on sale, it would mostly function as an autonomous vehicle. Musk stated that a low-cost electric vehicle, EV, would be developed in 2020 with a target price of roughly $25,000. At Tesla's most recent investor day, no information on the car was provided, despite investor expectations. However, Musk recently gave a status report on the vehicle in an interview at the Morgan Stanley gathering. He clarified that the company's plan is to produce a smaller car that will almost entirely run on autonomous power and cost roughly half as much as the Model 3. Musk stressed that Tesla needs autonomy and that the company's greatest progress to date can be seen in the quick development of the entire self-driving system. Cathie Wood has a history of changing her mind, as evidenced by her fluctuating attitude on GM and legacy automakers, according to Jim Cramer, a well-known CNBC anchor and personality known for his honest thoughts on people and equities. Wood recently made her first investment in General Motors after cutting back on her holdings in Tesla Incorporated, a well-known manufacturer of electric vehicles. Last week, Cramer talked about the underperforming stocks of Ford Motor Company and General Motors on a CNBC program. However, he refrained from recommending investing in General Motors, noting his concern that Cathie Wood's involvement would have a detrimental effect. GM appears to be performing well, but I'm wary of Cathie Wood's involvement, which may not bode well, Cramer said. Cramer stated, "I think Cathie Wood is the kiss of death, but GM's doing well," in a recent CNBC segment. During a recession, Jim Cramer advised investors not to buy General Motors stock since it would probably take further substantial drops in value before bigger investors started buying the stock. He used prior examples of Warren Buffett making purchases during market lows as support. These comments come after Cramer recently criticized Palantir Technologies, a stock connected to Cathie Wood, dismissing the firm as one that probably wouldn't have drawn much notice if Wood hadn't been involved. Jim Cramer recommended his viewers to short Cathie Wood on a Mad Money program in January. They might also think about investing in the Tuttle Capital Short Innovation ETF, which is intended to wager against Wood's primary ARK Innovation ETF. He attacked ARK for having a drowning scene in the show and for being the ultimate hedge fund that held traditional growth equities. On social media, though, a lot of people were eager to draw attention to Cramer's earlier remarks, which were made less than a year ago, in which he called Wood a genius at the height of the performance of her ADS. Eric Balchunas, a senior analyst at Bloomberg, noted on Twitter that Wood's ETF had dropped 50% since Cramer's February 2021 recommendation, highlighting the irony of Cramer's advice. Wood ought to stop making new investments in ARK funds and instead focus on enhancing performance, according to Cramer. One reason why traditional automakers are finding it difficult to switch to EVs could be early, insufficient investment in reasonably priced EVs. With its significant investments in low-cost EVs, Tesla might become the market leader. It's unclear how long GM and the EV business will remain profitable, and their futures are clouded. How do you feel about these matters? Please leave your comments below, as well as like and subscribe. We appreciate your time, and we'll see you in the upcoming video. I fixed typos, enhanced readability, and kept the essential points and organization.